RRSP, RPP, TFSA, ETF. Does it feel like understanding investing these days is a bit of like fighting your way through a maze of jargon? Well, you're certainly not alone. For instance, U.S. research firm Dalbar has looked back over the last decades since the mid-1980s. And one of the things that they find that's quite compelling is if you look at, say, the last 30 years since the mid-1990s or so, the S&P 500, which is the kind of market cap weighted highest valued 500 stocks that are traded in the United States, they've averaged an annualized return of about 10% a year over that same time period. Now, when you compare that performance to the performance of the average person invested in an equity fund, they've actually only earned about 8% over that same time period. And so if you want to understand, why that kind of difference can matter, if you had invested $100,000, back in the mid-1990s, at that same time, and it earned, kind of that benchmark return or that 10% return, just because of the way compounding works, you'd have over, $1.8 million by the end of 2023. Versus if you earned what the average investor instead earned, you'd have just over $1 million. And so as you can see, there's pretty significant differences to, these what are seemingly small differences returns over time. And one of the things that they've found is that, there's a lot of kind of individual investor mistakes that can be the difference between, earning what potentially you could have earned over that same time period and what an investor will actually earn. And so I think one of those things can come down to how long people are, invested in a particular fund, for instance, or, how they behave in times when markets are really booming. And, it's a very exciting time to maybe particularly overinvest in exciting products. And similarly, in times of really high volatility, you might also find yourself being very nervous and potentially walking away from some investments that might have ended up doing quite a little bit better if you, waited out the storm, so to speak. And so I think when we're thinking about how that's relevant for younger investors is the earlier that you can get kind of a footprint in, what it actually means to be an investor. What are some of these products out there that are available to you? What are some different strategies out there that matter? I think all of this is a really important context to learn early on in your investing career. And so I'm Erik Johnson. I'm Vice President and Senior Economist at BMO Capital Markets. And you're listening to another special episode of our BMO Smarter Investing podcast, where we're highlighting topics relevant to our younger audience members. Today, I'm very happy to have one of our senior investment advisors from BMO Nesbitt Burns, Pouya Fattahi, to help us learn how to navigate the investing landscape as a younger investor. And so welcome to the pod, Pouya. Really happy to have you here.
Hey, Erik. Thanks for having me.
And, I guess if you don't mind, certainly I'm a little bit familiar with what you do here at BMO, but if you wouldn't mind for the audience members, what kind of things are you involved with as an investment advisor at BMO Nesbitt Burns?
Yeah, absolutely. So I help high net worth clients and investor enthusiasts, if you will, really put two really big components together. One being the goals that they want to achieve, whether that's short-term, mid-term, or long-term, and then bringing in the right investment strategies to align those two things together to make sure that the risk tolerance and the risk capacity for that individual is in line with how they want to mitigate the risk going forward to achieving those goals.
Awesome. And so one thing I kind of teased at the start of my intro here is this, there's a lot of acronyms when we're thinking about the investing landscape for a Canadian out there with, what kind of accounts I can have, what do they all mean? What are their purposes? And so one thing I was hoping you might be able to help, some of our younger audience members understand is, what do these kind of things mean and how should I be thinking of them as a younger investor?
Absolutely. So let's get to RRSPs ASAP. So with RRSPs, that stands for Registered Retirement Savings Plan. That is essentially designed for retirement. So the really neat thing about RRSPs, Registered Retirement Savings Plans, are when you earn income and that income is taxable, you are able to contribute to an RRSP and get an immediate tax deduction, and kind of think about it as you're getting the tax break today, but you're paying your future self, where that investment then grows for many, many years, and it's sheltered from any taxes until you start withdrawing those funds. So it's a really, really powerful and neat investment vehicle that's available to Canadians. And we just have to remember that it has to be converted into what's called a registered retirement income fund, or a RIF, by the age of 71. But for our audience, that's a long time away.
Absolutely. And I think one thing you brought up that certainly is intriguing to me is this idea that, by the time you're perhaps, taking money out of your RRSP, the idea is that maybe you're taking it out at a potentially different tax rate, or, maybe a lower tax rate than you might find yourself in your sort of core earning years. Like, a younger investor might find themselves as they're, kind of climbing up the earnings ladder there. Is that kind of right in your view as well?
Absolutely. Because theoretically, as we, enter the workforce, our income, hopefully, continues to increase and go up the ladder. But as you retire, because you're theoretically not going to have a lot of the expenses, hopefully not a mortgage payment and other things, your income that's going to be required for your living expenses in retirement is going to be lower. So the kind of the theory behind it is defer taxes today where you're in a higher tax bracket, and pay them down the line when you're going to be in a lower tax bracket.
Yeah. And so one of the things that I sort of teased at a little bit when I was talking about some of that research from Dalbar, but also just, I know you're really big on this as well, but for a younger investor, why might it make sense, at the early stage of their career to start thinking about putting money into something like an RRSP?
Absolutely. I think one word sums it up, and I think you alluded to it as well, Erik: compounding. One thing that young investors have is their age. So let's say, for example, you're 25 years old, you just entered the job market, and you're kind of what I like to call a chip away strategy. You're just paying yourself, chipping away a little bit, let's say $200 a month. Doesn't seem like a lot, but if you continue to start contributing that $200, that's $2,400 a year. That's being invested in the markets, and we'll get to that in a second. And that continues growing for you, but now your income for that year is $2,400 less. And year by year, like let's say you have a 5, 10 plus time horizon in terms of investments, you are now compounding those returns on top of one another. And one of my mentors when I started in the business mentioned it's kind of like grass, right? Like you don't cut your grass for a week, it doesn't make a difference. But then, as it's 2 weeks, 3 weeks, 4 weeks, it's a lot taller in terms of the grass height than before, right? So compounding is huge. So that the sooner you can start taking advantage of the time frame, the better off you're going to be in the later years.
Awesome. And so one of the other, acronyms I went through as well, and one of these other accounts that are available to younger Canadians, and certainly any Canadian over the age of 18, is that tax-free savings account, or the TFSA. I was wondering, could you walk us through a little bit, how that might be different than, some of the other accounts we've talked about so far?
Absolutely. You forgot TFSA. So there's a lot for it. Yeah. So the tax-free savings account, I would say it's a little bit more versatile. So you have the ability of contributing into a TFSA at the age of 18. And we have to also remember you do have to be a resident of Canada. And the neat thing about it is once it starts growing in the TFSA, like you have an investment strategy and you implement it in a TFSA, a tax-free savings account, that growth, when it's time for you to, you need the money for something, that growth in that TFSA is absolutely tax-free. Now, you don't get the tax deduction like an RRSP, but it's really, really good as a starting vehicle or starting investment account, in my opinion, because, you may have shorter term or midterm goals that you can then resort to the TFSA and really, utilize the tax-free ability of it. So again, like for example, let's say you save yourself $100 a month in a TFSA, that starts growing for you. Then you find your dream job, but it's 25 kilometers away and you need a car. You can actually sell the investments in a TFSA, pull it out absolutely tax-free with the capital gains or the profits that you've made, and utilize it for your shorter or midterm goals.
Oh, awesome. And so, yeah, one thing that surprised me a little bit when I was diving into this is if you look at some of the, statistics that come out of the, long-term usage rates on some of these products. So I think overall, as of 2020, when you're looking across households, a little bit over 60% had, investments in some form of registered retirement plan or RRSP or TFSA. But, as you said, right, like this TFSA product is, pretty versatile. But I think as of 2020, something like only 20% of Canadian households had, any amount of savings kind of in that vehicle itself. And I guess what, kind of stands out to me a little bit is this idea as a younger investor, right? We've talked a little bit about how compounding matters is, the earlier you can get yourself into an investment vehicle like that, the more time you're giving yourself to kind of benefit from that horizon that you have ahead of you. So now that was one thing that kind of stood out to me with some of these different accounts that are out there for Canadians.
Yeah, absolutely. Like whenever I speak with younger investors, whether it's, my clients' kids or grandkids, et cetera, I'm always trying to, send the message of think about your future self, because 5 years is coming. It seems like a long time. 10 years seems like a long time, but it's coming. So if you can start implementing some of these really simple strategies today, you're going to be so much better off because of the power of compounding. And the TFSA, the tax-free savings account, is one of those vehicles, I think, for young investors. It's a really phenomenal way to get started.
Awesome. Thank you so much. And so one other product that's a little bit newer to the mix as of the last couple of years is this first home savings account, or I guess to add another acronym to the mix of this jargon maze we talked about earlier was the FHSA. And I guess what I was trying to figure out there is, how is that investment vehicle a little bit different, say, from the other registered accounts that are available to our audience here?
Yeah, absolutely. It's a very new investment vehicle. The way that I like to explain it to my clients is it's the hybrid of the RRSP and the TFSA kind of combined together. So for example, you can contribute $8,000 into a first home savings account, an FHSA. That's going to be actually tax deductible like an RRSP. But when it's time for you to buy a home, you can actually pull it out like a TFSA and utilize it towards your first home. And, I think that there's a lot of young Canadians looking for all different kind of strategies and ways to help out with that first purchase.
Yeah, absolutely. So anyway, I think that's very helpful for kind of setting the landscape of what's out there. I guess the one other missing piece of that conversation of what kind of an account someone could open was this difference. We've talked about registered accounts. The other kind of, if I went to a bank or another brokerage firm, I could also open up a, potentially non-registered account, as they're referred to. So maybe could you walk us through a little bit about, what kind of account that's for and, when might be a time to open an account like that for a younger client?
Yeah, absolutely. I think it's a really useful account as your wealth starts to grow. But before I go into it, I think it's important to point out that you still want to try to maximize the TFSA, the tax-free savings account, and the RRSP, the registered retirement savings plan first. Get all the tax breaks from those vehicles first. And then once those, because those do have limits, once those are no longer an option for you, you can then invest in what's called a non-registered account. The most simple way to explain it is it's in the name, right? It's a non-registered account, meaning there are no tax breaks. So whenever you do pull money or you sell a security or any asset that's grown in value, which we call a capital gain, you will be taxed on that, right? Hence why utilizing the TFSA and the RRSP becomes so much more important, but there are no limits to the amount of capital that you can invest in a registered account. The only little consideration is you do have to be the age of majority for most parts, whether that's 18 or 19, depending on the province that you're in. But that's, again, I think the third option to a nice lineup of investment accounts to really get you to where you're trying to get to.
Okay. And I guess if you were starting out as, a young investor yourself, would there be a particular order that you'd sequence, your kind of savings on a monthly basis into, one of those accounts? You touched on a little bit the idea, let's fill out our, allotment of registered accounts first to, prioritize kind of those available tax breaks to ourselves. But is there, between those registered accounts, is there a particular sequencing that you recommend to younger investors?
Yeah, there's no exact right or wrong, but I would say that if you're in a lower tax bracket, it would probably make more sense to start off with a TFSA first. And then once you've maximized the contribution limits to a TFSA, then I would go to an RRSP. And then once that is maximized, then I would resort to a non-registered. With the caveat, or with just a little asterisk on the TFSA, if you come out of college, university, and you land an awesome job, and it puts you right away in a higher tax bracket, then you may want to then consider the RRSP first and then the TFSA. But it's interchangeable between the two registered investment vehicles or accounts, which is TFSA, RRSP, or vice versa.
Awesome. I think that's very helpful because certainly when I talk to people my age, there's always a bit of confusion over, where I should put my money and what that kind of sequencing can look like to, make the most of the available savings, especially at a time when, more and more young Canadians are finding it, more of a struggle just to set aside any money at all, given kind of where cost of living pressures have been. So, we did talk about it a bit earlier, this idea of, this a little bit of a confusing maze of possible products out there. There's people talk about crypto, people talk about stocks, they talk about bonds, they talk about mutual funds, all these different things. And I was wondering, from your perspective, what are the kind of big important asset classes to understand for a young investor, and what might separate why they might want to choose one versus another?
Absolutely. So stocks, I think we've all heard that word before, equity stocks. Think of it as ownership in a company, right? So one of our darlings in Canada is Shopify, right? So if you want to participate in the growth of a company like Shopify, then you would want to be a stockholder or an equity owner, buying equity of that company. Obviously, anything that has a higher growth potential usually has a higher risk potential as well, right? So we have to be careful because there's a lot of different kinds of stocks out there. There's companies that have their stocks issued and they have a lot of profit. Those are, what we call fundamentals that we look at. And then there's other companies where they're more growth oriented. They have an unbelievable, idea or concept or business model, but unfortunately they don't have the profits yet, right? So you have to be very cognizant, and that's where the research comes into play. If you're going to start selecting individual stocks, where you want to look at that company and say, okay, which company do I want to be an owner of? And that's kind of, the process, if you will, of selecting a stock. And also it's ideal for long term. Again, that power of compounding, you want to make sure that you are in assets, if you have a long enough time horizon, in assets that are going to grow potentially at a higher clip. And stocks historically have done that. I remember reading The Intelligent Investor when I was 19 years old and not understanding 99% of it and had to read it a few times. But one of the greatest wealth creations in Canada, in the US, around the world, has been the opportunity for us to become investors and participate in the capital markets in Canada, US, globally. The next one is bonds, right? So you're essentially providing a loan to a company or the government, right? So that obviously is a little bit less risky. So think of it as, you know what the fixed interest is that you are going to receive. There is a time frame for this bond. And once that bond, as they say, matures, then you actually get your principal back, or the money that you've lent, and you get to keep the interest, right? So it comes back to compounding again, and that's going to be the word of, I think, the podcast. If you have a longer term time horizon, you may want to start with a little bit of bonds, and as you get older and as you get closer to those financial goals, you may want to increase it to reduce the risk or volatility in the portfolio.
Yeah, so I guess one question you touched on when you were kind of going through bonds versus equities is you talked about this idea of, long term. And so, one of the things that struck me when I was reading through some of that research, say by Dalbar or others, when we're talking about average holding periods for some investors being, under 5 years for an equity fund, is your view, if I'm, going to be, a little bit more open to volatility and buy a stock, should I be thinking of that more as something, much beyond a 5-year holding, or what would you kind of consider there in that lens?
Warren Buffett comes to mind, Erik. He says, and I'm paraphrasing, but when he buys a company, he wants to hold it forever, right? So I think I haven't read that report, but if you're holding an equity fund for 5 years, it seems like a lifetime, 5 years, right? But it may not be enough time to really allow some of those stocks to shine. And what I mean by that is, and if I get too technical, Erik, just please stop me. But we look at market efficiencies, for example, right? The whole premise is, when I want to pick a company, sometimes when I look at the financial statements of that company, and this is what my team and I do as portfolio managers and investment advisors, is, okay, we believe that the intrinsic value, or the value of that company, is much greater than what the market is pricing it at, right? So you have to be patient, and sometimes you have to be patient for a very, very long time. And in this day and age where we want results tomorrow, that the fundamental aspect of it becomes a bit more difficult. So I would say, if you're looking at a more equity portfolio, and everybody's different, of course, I define long-term anywhere above 5 years, right? So let's say, for example, you think you're going to be buying a home in the next, 3 to 5 years. I would personally define that more in the midterm range. And you don't want to go too high equity, because you probably need those funds for a down payment, or, furniture. You have to sit somewhere, right? Yep. So I would kind of keep that in mind. And you got to then have buckets. My midterm goal is buying a house, for example. It may be a long-term goal. Depends on where you are in your life. Retirement planning. Everyone, they're like, well, that's many, many years away, but you want to have a bit more equity if you have that longer term time horizon. So it really, it's based on what your time horizon is, what your goals are, and how bad you want it, right? Because then that could really help you with determining what we call risk tolerance, right? Because you may say one thing, but then 2022, 2020, 2018, 2015. I'm just kind of going backwards. 2008, 2009. We're gonna have some not so fun times in the economy and in the market. So you have to make sure that your risk tolerance is appropriate for the time horizon. And like I said, when I think you mentioned 5 years, 8%, was that the return on it?
Oh, yes. I was just comparing the idea that, like, over the last 30 years or so, the S&P 500 returned about 10% on average every year. And if you compare that to the average investor, they got about 8% over that time period. So the idea is that sometimes, as you kind of were pointing out there, they might be getting nervous when times are too volatile, and maybe so they're selling kind of at a bottom. And maybe when times are really exciting, they're thinking, oh, the market's doing great, I'm going to buy into all these really popular funds. But of course, they might at that point be buying into a peak. And so they're trying to a little bit time the market rather than, just waiting out their time and thinking, I'm happy with my risk tolerance, my investment strategy, and I'm just going to, ride it out and kind of see that overall, kind of market return. So exactly to your point, right? That sometimes you have to be a little bit more patient, and it goes against a little bit of that human nature that you were, teasing at, right? This idea that sometimes it's very easy to get either lost in this real big exciting time or get, a little bit too nervous when markets are going through bouts of volatility.
Absolutely.
Yeah.
One last thing I'll mention to that, I think the audience would appreciate, is dollar cost averaging. Because if you feel like you want to get into the markets, but we're at all-time highs right now, you can still participate. Like, you can take your capital and you can slice out a little piece of the pie, and you can be in the markets and participating in the markets. And then you can just put in on a monthly basis, on a quarterly basis, whatever you're comfortable with. That way you don't feel like you're missing out. And if there is a pullback, or when there is a pullback, it's always a when, then you have enough capital to take advantage and average out your cost to that company that you have a lot of conviction or a lot of confidence in.
No, I think that's really helpful. So I know this dovetails a little bit into your breakdown when you were talking about equities and bonds, but two different, I guess we'll call mixed vehicles of asset classes would be, mutual funds and ETFs. And I was wondering, what are the kind of big broad differences between those two types of funds that investors can participate in?
Yeah, so mutual funds essentially are a pooled investment of many, many different investors who invest in this one fund that's being managed by a professional, a portfolio manager, usually. And that fund could be a mix of stocks, bonds, and other assets. And the nice thing about mutual funds is that you don't have to worry about the research or putting in the time. You just want to make money, for example, to achieve a certain goal. You just invest in that fund, and that professional will help you grow your assets, hopefully. So again, for example, there's the benefits of it is you again have some money, and you just put in $250 a month into a mutual fund, and you dollar cost average it. And as soon as it enters that fund, it's the professionals and his or her team that are going to decide where the best place is to invest. Now, with a ETF, here we go with another acronym, an exchange traded fund, similar to a mutual fund, but it trades like a stock. So you can actually buy it on the stock market, just like a stock. The fees are lower on an ETF, on an exchange traded fund. There's no age restrictions, by the way, on either of these vehicles. Like a good example is, like, let's say you wanted to buy the S&P 500, which is the largest 500 companies in the US. So you can actually buy an ETF that represents these 500 companies, and you can own this through an ETF. And it's ideal for passive investing, which we'll, I think, get into, and a cost-efficient way. And I always say, if you're a new investor, that's probably where you want to start, right? You want to buy an index, and then as your wealth grows, then you want to work with a trusted advisor or do it yourself and do the research. But I think the foundation is perhaps looking at ETFs and exchange traded funds and getting a nice breadth of different indices, perhaps in North America and globally. And then from there, adding to your shelf of investments, if you will.
Well, yeah, that's exactly kind of where I wanted to take the conversation, was this idea of, being a passive versus, having some of my funds more on the active investment side. I guess one thing I was really struck by in the most recent Canadian Pension Plan annual report, one thing that stood out to me is, I think in around 2006, CPPIB switch from being a little bit more of a passive investment fund to being a little bit more actively managed. And, this is maybe, a little bit of a pushback against active management, but I think, feel free to disagree with me at any point. I'm just the economist here, so I feel like I have to advocate index funds a little bit.
Absolutely.
But, one thing that they did mention is that if you compare, what the benchmark kind of index for CPPIB did over the last, almost 20 years now, they earn, I think, something like the benchmark was just under 8%, so around 7.8%, I think. And since active management, CPPIB has earned slightly less than that, like only a tenth less, so 7.7%. So again, pretty close to the benchmark, but a little bit of, I guess, an underperformance. So you might say, hindsight's 2020, which is like a little bit of an unfair way to think about it, but they would have been slightly better off just by opting for those lower cost kind of management strategies, as you were pointing out, than going in some of the higher cost management strategies that they've done. And I guess, one thing that stands out to me is last year certainly was a crazy year for, broad equity markets. I think, their benchmark was up almost 20% and they eked out about an 8% return. And so I guess, that's one thing that I've been thinking about in this conversation. So, there's these passive investment strategies that might be a little bit lower cost, but I guess one argument I can think of in favor of active management, right? If I'm someone who's going to be very nervous when times are bad and way too excited when times are good, then maybe one thing I'm buying in an active manager is someone who's going to have a little bit better patience than I am. And so, yes, I'm paying slightly more than that, but it's also maybe ensuring that I'm making on average better investment decisions than I'm going to be making kind of by myself.
Yeah, absolutely. I think those are all very, very valid and fair points. I think a couple things. First off, when you think about emotions, it's a lot easier to just talk about it than when you're actually in front of the screen and you're like, okay, what do I do? Right. And I'm a huge proponent, as you know, Erik, of financial literacy, financial planning, just for not only my own clients, but Canadians in general. Like, I think the last time I checked, FP Canada had a stat that 6 out of 10 Canadians do not have a financial plan, for example, right? So where professionals like myself come in, because I kind of wear two hats. I'm a portfolio manager as well as a financial planner, is going back to that goals-based approach that I think I was mentioning earlier in our conversation, where I try to figure out what the goals are for my clients. I'm not going to pretend like I'm going to beat the market every single year. I think anyone that does that, God bless them, right? That's not me, right?
Yeah.
What the value that I provide is helping my clients with all of the different 6 pillars of financial planning, which is tax planning, estate planning, retirement planning, investment planning, financial management, insurance, risk mitigation, and bringing that all together. Because if you have a plan put in place, the emotions really get reduced, right? And I think that there's a reason why individuals get either too greedy or too fearful and sell or buy sometimes, or I'm being nice, most of the time at the wrong time. So when you bring that kind of active management now with the financial planning, I think that provides a really interesting value proposition. But to what you're saying, as a young investor, right, where they're just starting off, I think index funds are perfect. I think that is where they're going to get their feet wet. They're going to understand capital markets. They're going to understand what it takes to research an individual stock, and not just because, Jim Cramer on Mad Money said you should buy it, yes. Right? So you really get an experience for it. But as your net worth continues to, you work your butt off, and, you start earning more money, and you attain more assets, or whatever the case is, as your net worth continues to go higher, I would say, consider working with a trusted advisor, someone that is a subject matter expert that can help you not only with the tactical or the active side of investment management, but someone who's going to bring all of these different pieces together like a puzzle to actually get you to, get to the next level, if you will, in your financial goals. But I completely agree with a lot of the things that you say. But there's still active managers out there that are beating the benchmark as well. So I'll kind of leave it there.
Awesome. No, I think that's a great kind of walkthrough of what all that stuff means for potential investors out there. So I appreciate that. And, one thing I think that you said that really resonated with me is this idea of, the purpose of setting aside money is this nature of what goal is that money being set aside for? Because I think, as an economist, that's something I'm certainly attracted to, because the idea of money itself doesn't really have any value. But what it does, provide me the capability of doing is whether it's, at one point in my life, I want to buy a home, or, I want to go on a bunch of nice vacations with my family, or I want to have enough set aside that I can retire at, the desired age and feel sort of financially comfortable. And I think so all of those reasons really stand out to me of why, it's really important to kind of have this plan-oriented approach to when we're making investings. And I think some of the best times to think about that is when you're at the youngest point of your investing career and thinking about, what am I setting aside money for today to do? And so I think to your point, right, that's one of the reasons why it's a great opportunity. Certainly, BMO has lots of people that, you can come in to talk to, whether it's someone like Pouya here or lots of other financial advisor teams to, get some of those plans. And certainly if they want to make some passive investments, we're also a very big provider of a lot of those kind of passive, ETFs that are going to do something like track kind of a passive index. And oftentimes, I think what's really neat these days is a lot of those on certain brokerage accounts and trading platforms even trade without fees. So even back to this idea that you're, really being able to participate in that market for a really low kind of entry fee relative to some of the other things you could go out and invest as a young person. So I guess Pouya, just to tie. Oh, go ahead.
I'm so sorry, Eric. No, it's just because you say some really good things, and it kind of sparks some ideas in my head. I think it's the best time to be an investor right now, especially a young investor, right? Because technology is allowing us to really approach investing in a whole different way, where perhaps our parents and our grandparents didn't have that opportunity. So the only thing that I would say is just get started, right? Because you're gonna like it. It's there's more fun times than not. But just have a process put in place, and hopefully podcasts like these and discussions like these will help you in creating that process for yourself, because it's such a great journey that you're going to be going on.
Awesome. Thank you so much. So just to kind of round things out here, is there any other last minute advice you have for young investors today starting out?
Just start. Just like the Nike ads, just do it, right? Just open up an investment account. We have BMO Investor Line. As you mentioned, we have a lot of amazing financial professionals that could guide you. But just open up an account and get started, right? That's the biggest step. The first step is always the biggest and the hardest. Just do it. Just get started, and I guarantee you that many years down the line, if you're doing the right things, you are going to be better off. And usually I don't use the word guarantee in my business, but this is one of those guarantees. Have the right process, be disciplined, do your research, do your homework, and if you have the right time frame, you're going to do some incredible things in your life with your portfolio.
Thanks so much, Pouya. So just thank you so much for joining and listening to our podcast today. We hope that we were able to walk through some of this, challenging environment that you might find kind of entering the world as a young investor, and, walking through this maze of jargon that's sometimes out there. But I hope we provided a nice spin of what some of these things mean, why they might be worth your time to kind of learn a little bit more about. And again, as Pouya mentioned there, to get started. So thank you so much for spending your time with us today, Pouya, and hope to have you on the podcast in the future soon.
Thanks, Eric. Happy investing.
Yeah. Thank you, everyone, and have a wonderful day.